Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. 18 weeks ago, I highlighted a bright pink July 24 to date rectangle pattern, currently 956 to 1098. This pattern is still operational, even now. The top side for this pattern is also capped by the nearby 50% Fibonacci line, the May to August 2024 move, also at 1098, and the 61.8% absolute Fibonacci line at 1106. Nearer term, the market over late April and early May had tried to stabilize over the November 2020 low at 1045 and looked for a while like it might try higher, but over mid-May and then mid-June we could see a capping action symbolized by the bright red, fairly flattish upper trend line on my daily chart, and that's currently at 1083. At the same time, the basis of the very recent action since late April also lined up into a lower trend line, currently 1014. Together they make up a proposed expanding wedge pattern that is still in operation. This is the immediate pattern to look to right now. Now I would also keep a wary eye on the somewhat flatlining long moving average below the market, currently at 1031. This had been penetrated last week and but proved to be a base of support for the subsequent move back up later on this week, and this is despite the monthly key reversal down we saw here last month. As a byline, we also had a monthly key reversal up in Chicago soybean oil, which I will detail later on in this video commentary, and I'll leave you to ponder on the imagery of one part of the soybean complex here making a monthly key reversal down, whilst at the same time another, oil, making a monthly key reversal up at the same time. Now a further feature which I have highlighted before on my daily chart, and which is still also very much operational, is the dark blue late December 24 to early April 25 bullish shift pitchfork. We are right now in between the lower time below, currently at 1015, and the middle time above, currently at 1080. And this is after we tested down towards the lower time earlier this week and rejected the move lower, thus verifying this lower dark blue bullish shift pitchfork and causing me to keep a very close eye upon it and all its tines going forward. Chicago soybean meal. 12 weeks ago I linked the recent highs into a bright red downtrend, currently at 291 even, that tied in nicely back then for a while with what was the descending long moving average, currently at 302.40. That was just about shadowing the downtrend but a little higher up, and with the medium moving average currently at 297.60, which earlier had failed to provide much resistance above but then energized itself as a resistance, and a quite good one over mid-May to mid-June. Now 6 weeks ago we had a clear close over the bright red downtrend, and prices tried to stabilize over this breached, possibly broken downtrend. However, the bears out there really relied on the overhead medium moving average to cap the market's rise, and so it did. This breach on the upside was just a breach and not a break higher, and I was not impressed with the show of any significant bullish incentive there. This all impinged on my thoughts from 14 weeks ago as to whether the whole action this year had developed into a type of descending triangle pattern, possibly even a descending wedge pattern, with the bright red downtrend topside being the upper trend line and the 290 level below being the base of the descending triangle, and also importantly the early January to date purple lower trend line, currently at 283.80, being the lower trend line for a proposed descending wedge pattern. I said 3 weeks ago, and I quote, "For the future, I think a lot will depend on any move down below 290 even to verify if it will be a descending triangle or a descending wedge pattern, or on any true break above the seemingly resilient overhead medium moving average, and ideally above the long moving average just above that, or any significant move higher." End of quote. I also added that My major concern is the same as it has been now for 14 weeks here, and it is as I warned back then and since, and I quote, possible false breaks here out of this proposed descending triangle pattern, end of quote. 2 weeks ago, prices broke down through the 290 even zone, the lower support for a descending triangle pattern, and last week they broke down through the purple lower trend line for the descending wedge pattern. The market has been trying to stabilize below this latter one ever since. This move lower has been enough for me to set up some possible targets below for both patterns. Thus, for the descending triangle pattern, we had a primary target in the 273.20 zone, with a secondary harder to reach target X down in 255.60. For the descending wedge pattern, we had a primary target down in the 272.30 zone, for harder to reach secondary target X1 down in the 242.80 zone. As you can see, I've already reached both primary targets for the descending triangle pattern and the descending wedge pattern, just leaving the harder, in some cases much harder to reach, secondary targets further down. This leads to this week's action, which I have seen a somewhat reactionary move back up from last week's low and earlier lows this week. It prompts the question, as I said earlier, is this break lower yet another false break, but this time on the downside? And is it something we see on occasion on breaks lower to descending wedge patterns, a dip that will swiftly revert higher and may start a new bullish move? It is too early to say as yet, so for now I will continue with targets X and X1 below. Finally, this commentary would not be complete without my discussing the elephant in the room, or at least the elephant in the room which has stayed there throughout 2024 and also resonates now into 2025, and that is the annual key reversal seen here at the end of 2023. I said, and I'm afraid I have to repeat something I've highlighted now for 108 weeks, yes, a full 2 years, and I quote, "And I only need to remind you once again of my words when I pointed out the Chicago soybean meal was about to make that rarest of patterns an annual key reversal down. This duly came about at the end of 2023, and we have been living in the shadow of this pattern ever since." End of quote. I've also added ever since, and I quote, "There's only one thing you take away from my musings, let it have been those words." End of quote. These last few weeks have shown that the shadow cast by that supremely significant pattern so long ago still darkens the skyline of this market. Chicago soybean oil. The main pattern here had been until mid-June, despite a breach on the upside 7 weeks ago, the shallow bullish shift pitch rule for the mid-September to late December 2024 move. However, 2 weeks ago we had a gapping changeover a higher up over the upper time, which is currently at 51.80, up to just short of the 50% Fibonacci line of the March 20 to April 22 move at 56.34, before a pullback to the upper time for some fresh ammunition last week, and a further move higher this week. Not as much, but still higher. This 50% Fibonacci line is quite interesting, as it is the gateway to overhead congestion that stretches from 56.34 till at least the top of my daily chart in the 59.44 area. All this action caused a monthly key reversal up here for June, and I've already mentioned the imagery we have for monthly key reversal up here in June, whilst a monthly key reversal down in soybean futures contract at the same time. This leads me to what may be the more dominant pattern right now, and one I've mentioned 4 weeks ago. It was, as I said at the time, and I quote, "A new pattern emerged over the last month or so, and one that I warned may kick off 2 weeks ago," so that's now 5 weeks ago, and has actually done so since. Though the break has not fully stabilized as yet, it is the dark blue start of April to end of May ascending expanding wedge pattern, currently 49.81 to 56.84. And that's the end of the quote. This pattern has the requisite number of touches on each side, and late 5 weeks ago had a brilliant breach and break lower. But, as I said 4 weeks ago, and I quote, "Clear consecutive closes below this dark blue lower trend line, and I will feel obliged to lay out potentials and even possible targets below for this pattern. Something I am not confident in doing just yet, as I fear a possible false break lower." I can only emphasize something I have said only 2 weeks ago, so that's now 7 weeks ago, and that was, and I quote, "It wouldn't surprise me to see some sell stops situated in a distance below this 38.2% Fibonacci line." I think today we have seen those sell stops being triggered once again, end of quote. Well, 4 weeks ago I felt obliged to lay out some targets below for this pattern. Arguably, the market reached a pretty easy primary target down at 46.03, but I also added a secondary harder to reach target down at 45.03 at the 2014 high below, and a tertiary much harder to achieve target down at 43.74 at where the 50% absolute Fibonacci line resides. These were quite big targets to achieve on the downside, and I mentioned at the time that they started to seem, well, unlikely. I have since retired them in the light of the action at the dark blue ascending expanding wedge pattern. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.